On today's show, 3 questions. Number 1, how's the labor market? Number 2, are you behind on retirement savings? And number 3, what's the cost of denial? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Victoria.
And I'm Rabih.
Yeah, you are. Second of the day, everyone. For those of you that don't know, we normally do these every Friday. They get released on Saturday, so we try to keep things as pertinent and timely. There you go.
There we go.
And timely as possible. But today we are doing 2 in a row because next week a good chunk of the group is going to Dallas for the Productive Dentist Academy event. PDA, shout out Christine Ewan, we love you, and the whole PDA team. So we're going to be out there next week for their 20th annual summit. Huge deal. There's a big group of us going out. So because of that, we thought we'd just do 2 this week. So we're a little ahead of schedule. This isn't going to be as timely. There's stuff that's going to be happening next week. We're not going to probably cover, obviously, because we can't look into the future. So keep that in mind as we're covering this. This is going to be a week ahead. But let's jump in first. Rabih, how's the labor market doing ahead of the September 18th Fed meeting?
Thank you, Matt. So when you're listening to this, this week on Wednesday, the Federal Reserve is going to meet. It's the most anticipated September meeting. We're going to get the summary of economic projections. They're going to be cutting interest rates for the first time after the last time they cut interest rates were COVID, actually. And then we had this whole run where they increased them.
How does this line up with the Bachelorette finale? Is it close? Have we already hit that, Victoria? He's just saying anticipated. I'd imagine Bachelorette is also equally as anticipated.
Oh, that's already.
Is it done?
It's done.
Shows you how into it I am. I was just saying it's got to be pretty close. It's like Bachelorette Fed meeting.
Yeah.
It's
well, now we're all focusing as an office on Dancing with the Stars.
Yes. Got it.
Because Jen's on it and Joey from The Bachelor from last. Why are we talking about this?
I'm just saying we are anticipating the Fed meeting equally to Dancing with the Stars or The Bachelor, or for me, football season. Anyway, Rabih, continue.
Back to you, Rabih.
Back to you, Rabih, in the studio.
So, talking about the Bachelor of my world, Jerome Powell is going.
Oh,
we
so good. That's awesome. He's the ultimate golden bachelor. Yep.
The golden bachelor of my world. Jerome Powell is going to be setting expectations on the market. Victoria, are you okay?
We lost her. That was really good.
You tend to do this the last time you did this is when I came on and talked about pumpkin spice lattes, and you really just thread the needle there, and you were like, well, Jackson Hole is the PSL of this season. So you always find a way, Rabih, to connect our topics.
I love it.
Thank you.
So your bachelor, Jerome Powell.
Our bachelor, Jerome Powell, is going to be setting expectations on the market. As of now, which is 2 weeks ahead of the meeting, but as of now, the expectations for what the cuts are stand at 77% for a 25 basis point cut and a 23% for a 50 basis point cut. So there are still some hopefuls in the market that Jerome Powell will be like, guys, I'm going to give you what you want. Here's a 50 basis point cut. Let equities soar. I don't think it's going to be there, but they're going to be setting expectations. And the most part of it is going to be the summary of economic projections, because that one tells us what GDP is going to look like, and that will reflect the second revision that we had for Q2. So now the big question will be, will we average for the year above the 2% target that they initially set and reiterated in the first 2 quarters? We're going to be looking at unemployment rate, and we're going to see whether they still think it's going to stay at 4% for the end of the year, although we are at 4.2 now as of the reading that we got last week. So will they revise that upwards, and by what magnitude? Because we know that once unemployment starts getting out of hand, it accelerates. So that is something to look at. The third one is going to be what they think interest rates are going to be for the end of the year. Right now, actually, I was looking at expectations. By the time December comes, this is what the market thinks. This is not what the Fed thinks. The market is definitely ahead of itself over here. But there is around 50% chance, give or take, that interest rates are going to be below 4.25%, and 50% chance that they're going to be above 4.25%. But if we are at 5.5 right now, by the end of December, going all the way down to 4.2, so the market is really just looking at the Fed funds rate, which is not the whole idea. And those, by the way, are volatile. So looking at them tomorrow, those probabilities might change. It's just saying that some people are pricing in through the contracts that they're going into that the Federal Reserve has to come in with a 50 basis points before the end of the year, which is...
And this is tricky, right, Rabih? Because it's kind of a double-edged sword, because the Fed is so, your bachelor, Jay Powell, is so data dependent, right? He's so evidence based, and what he's, like you're saying, he's going off of all this data, and the only way that he would cut that aggressively is if the economy's not doing well, right? So that's kind of the double-edged sword here. Is that's why that's what we've been saying over the last several weeks, is the market feels like it's pricing in a recession, because the only way I think he goes 50 on this first meeting, and you tell me if I'm wrong, but something's got to drastically change. We've got to hit like some crazy unemployment reading that jumps like not 0.1, but 0.5 all of a sudden, I would imagine.
100%. You described it perfectly. It has to be drastic. You were going to hear it on the news. We're going to see weeks of red downturns in the market on end, right? There's going to be something that catches everyone's attention. When your non-investment friend starts texting you about it, then know that the Fed's going to, for those in the circle of investments, it's going to take more than that to, prompt the Fed to actually interact. It has to.
You know what I call that? The Uber driver rule. If your Uber driver starts bringing it up, it's a problem.
Yes.
What do you got against Uber drivers, man?
Nothing. I'm just saying it's kind of like a general rule. So like when I knew crypto was out of control during COVID, like that post-COVID craze of like all the crap coins, we'll say, and all that stuff going on, it was, again, it's the Uber driver rule. The second your Uber driver starts bringing it up, is just like, okay, this is out of control. Totally. I've got nothing against Uber drivers, nothing at all.
That's a really good rule of thumb.
Normal
That's
person.
a really good rule of thumb.
Yeah. The second they bring it up, I'm like, this is out of control. Or the other rule is when my dad starts calling me about it, I'm like, okay, this is out of control now.
So, looking at all these data points that we're going to get, I think the most important one, and this is what's driving the risk of whether we're going to be facing an economic slowdown or not, is the labor market. And we've been seeing a slowdown in the labor market. I got us some data that actually draw the picture of how the labor market has been evolving. And this is going to give us good context for when we review the economic summary next week. So the first one we can look at is the unemployment rate. We know that it dropped all the way down to 3.5 back in 2022, which has been the lowest, stayed at around 3.5, 3.6, all the way until January, beginning of this year. And in January, we were at 3.7. And then 3.8, 3.9, etc., and we closed July, which was the highest, at 4.3, and now in August clicked in at 4.2. So for a year and a half, we were stuck at 3.5%, 3.6%, and in January we were 3.7, and since then it's been accelerating all the way to a 4.2 as we stand right now, 8 months later. So a big idea of it is that unemployment accelerates and you don't want it to get out of hand. And this is what the market is, why pricing in probably a more aggressive intervention by the Federal Reserve. This is unemployment. This is where we stand. We'll see what their expectations are. But I think the most important analysis that could be done about the labor market, because the unemployment number tells us how many people are in the economy who are unemployed but are searching for a job and they can't find a job yet, not just the people who choose to be unemployed. And this just tells you how many people are trying to plug themselves back into the economic system and they can't. But this whole idea actually depends on how many people are competing for jobs and how many jobs are there to start with. So and part of the reason why this unemployment rate might accelerate is because if you have so many job openings, but there aren't really a lot of people searching for jobs, the unemployment rate will be low. But when suddenly you have so many people searching for jobs and also not so many jobs out there, the unemployment rate as a number will jump really quickly. So it's not just a first order of, oh, here's how many people got employed, how many didn't. It's more of multi-factors acting at the same time. How many jobs are available, that changes every single week, and how many people are unemployed due to them being fired, and it changes every single week. So there are two, and that's why we call it the labor market should be in balance. The supply and demand should be in balance. So let's look at the supply and demand and see where it stands. So I wanted to, hold on, sorry. We'll have to edit this. I wanted to click
did
on
Rabih
it.
just say shit?
Yeah, sorry.
Rabih.
Guys, I'm clicking on the tab to open it and I exited it. I clicked X.
Command Shift T.
That will, okay. Oh, anyway, I found it. Job openings. Sorry.
I also totally saw you spill your coffee, Matt.
In my crotch.
Like it went,
I
and
did.
then you were like,
Yep. I don't even know how
Okay.
that happened.
Are you guys ready?
mm-hmm.
I got it back. Okay. So looking at the supply and demand part of the labor market, there are two things to look at. On one hand, we've got the job openings, which are total non-farm. And then we've got the unemployment levels, which is like the actual number of people who are unemployed in the economy. Just to give you some context, I have data from like 2001 until 2024. From 2000 until 2018, and this is going to speak masses to how the economy has been growing and what we saw in the bull market, et cetera, at all these years, the unemployment level, aka how many people were unemployed, was much larger than how many jobs were available, job openings. And if you guys remember from like the recovery from the 08 crash and especially in the 2015, 2016 area, we're always talking about something called a liquidity trap, where it's like we have an economy that's booming and unemployment is low and we don't think inflation is going to ever come back. Like, remember, that was the conversation. For a while. It's like, just because we have a certain amount of job openings, although the unemployment rate was above it, we have people who are unemployed more than jobs are there. So this is not going to cause inflation. And the economy was doing good. So it was growth without inflation. And we said, oh, will we ever go to a period where there's inflation? Interestingly enough, that trend lasted for 18 years. But then in 2018, it flipped. For the first time in a good while, we had more job openings than unemployed people. So they're not always going to, we've said this many times, they're not going to always fill, like every single opening will have a person to fill it, just because there's going to be systematic changes about the technical skills that each job requires and what the technical skills the employees have, etc. But for the first time, on an aggregate level, there were more job openings in the economy than there were people who are unemployed, who are searching for jobs. That is when actually inflation started ticking up a little bit, and the Federal Reserve, without any, macroeconomic reason, started saying, let's start increasing interest rates slowly and slowly. But then there was the liquidity freak out and the Christmas crash happened. That's the labor market explanation for what happened in the equity market back then. There were more reasons, but that was one of them. So, and then COVID happened. That relationship reverted to what it has been for the previous decade, where you had more people unemployed than jobs available. But as we started printing money, stimulating the economy, that relationship switched back to that new phase that emerged in 2018. And we've had a prolonged period of time where we had more people, more jobs available than people unemployed, to an extent where at its peak, at its maximum, we had, which it was around March 2022, we had around 12 million jobs available in the economy, but only 6 million people unemployed, which means we had, for every unemployed person, 2 jobs for them. And that mismatch in the labor market. This mismatch in the labor market is actually what allowed inflation driven by unemployment to be fueled up. So the Federal Reserve,
and where we saw real wages for the first time in a long time actually tick up right during that period.
Yes, because you had so many.
It had to,
because labor was in limited supply and everyone wanted labor. So the Federal Reserve intervened, start cutting interest rates, and they were talking about how they wanted to thread the needle. And I think the important policy was here that they tried to bring down the available jobs available without affecting the level of people unemployed. So usually if there's inflation, the basic simple scenario we know of, the Federal Reserve will increase interest rates, puts the economy into a recession, gets rid of inflation. Like, this is what we know of. Like, this is what we hear of. But if they are doing this, this means that they are, on one hand, bringing the jobs available down and increasing the people who are unemployed quickly up. So the gap between them disappears and you bring the market back into balance. They did not want to increase the number of people who are unemployed. They just wanted to drop down the number of jobs available, which what have been coined for a while as soft landing. So soft landing is we're going to bring down the number of jobs available without trying to affect the number of people who are unemployed, unlike all the other times where we dealt with inflation by just breaking the system and doing a hard reset by affecting both of them at the same time. And since then, from that $12 million jobs available in the economy in March 2022, all the way down to now, we now stand, as of July numbers, 7,600,000 jobs available, right? And for unemployment, while we were at 6 million unemployed people in March 22, we have increased only up to 7,100,000. So there is a 500
gap is closing or has
The
closed.
gap's closed. The gap was 6 million. Now it's only 500,000. But most of that progress has been made on the front of jobs available. They are decreasing rather than the front of
actual people being unemployed.
So the unemployed people increased from 6 million to 7.1. So 1.1 individuals increased, whereas the job openings went from 12 million job openings available only to 7.6 million. So a drop of maybe 5 million available jobs disappeared from the economy. And this is very interesting to look at for multiple reasons. On one hand, this is probably one of the first time in the economy we're able to tackle one without tackling the other. I mean, like jobs available and not. This is why the merits of a soft landing is happening. Two, the gap is now so close. And we are at a threshold where that interaction and ranking might flip. And if it flips, it means that there's going to be more unemployed people than jobs available. And this makes the land more fertile for a recession to spur. So that's why this meeting is important from a macroeconomic perspective, because we've been dealing with a trend. Policy have worked in a certain way, and it's about making sure that your final draft keeps your essay looking good. In a sense.
I love this, Rabih. And two things I want to highlight that show the importance of going a little bit further than the headline and asking the question or some form or fashion of compared to what. So meaning when you say the first thing you said at the very beginning was right now as of the last reading last week, the unemployment number is 4.2%, came down from 4.3. Historic average, I think we're right there. Like it's still we're on the low side, yes, right, of that 4.2. But if you go a little bit further, you say compared to what? And what you're saying is it's not necessarily the number. It's not the reading right now. It's the acceleration of what we've seen from historical lows for about a year or more of the 3.5 to now the 4.2, 4.3 range. And that momentum we've seen historically can turn into a recession pretty quickly on the unemployment side. The other thing that you highlighted is this gap that you perfectly explained of saying we had such this massive gap of 12 million available jobs, only 6 million. If you just look at the headline and someone says that gap is now down to 500,000, that's all you heard or saw. Again, take it further. Compared to what? And what you're saying is, actually, this is good. We closed that gap by simply removing available jobs, not by increasing unemployment numbers. So it's really, I just think you highlighted that so well. I wanted to summarize that to say, you look a little further, look at the second order of thinking, or just be like, when you see these media headlines or whatever, go a little bit further and say, again, how are we getting to these numbers? So, Victoria, any thoughts on any of this?
No, I hadn't heard that before. Like, where is that really being, or where is that coming from? Like, is it like the gap, right? Are we bringing that down, or are more people jobless? So that was really interesting to hear. But yeah, I think that's such a good point to not get stuck in a headline, because the numbers itself, it's just a number. You can decide to tell whatever story you want to tell, which is why media is so big.
Yep.
Because they tell whatever story is going to make them the most money. I know we hate on the media a lot on here, but
I mean, I know negatively tilted almost every time, right?
Right. Yeah. So I think that's so important. That's a good reminder, Matt, to say, like, relative to what is this historically, and to really get a good understanding of what the numbers actually mean versus the story that the media is incentivized to tell you.
Yep, totally. Okay, this is awesome. So, Rabih, basically what we're saying is tease alert. September 18th, the Fed meeting. We have a, let's just double check here. We're going to have a 2 cents 2 days later. So that same week, obviously, like we do this every week. So that's going to be a critical one for us to break down the Fed meeting and what's happening. I'm sure at that point, the market will have reacted to whatever the Fed has done. But we are saying 77%, well, not we, the market is pricing in close to an 80% probability of a 25%, or sorry, 0.25%, 25 bips drop in the Fed funds rate. Still a chance of 50% or 0.5% drop, 0.5%, but most
depends
likely
on
not.
what happens between.
I guess
now
it
and then.
depends. Yeah, we have a couple of still weeks to see. Okay, awesome. Next topic: are you behind on retirement savings? So this one, actually, what?
Rabih just went like,
Did you say yes, you are, Rabih? Rabih's like, yes, I am.
He's always going to feel like he's behind. That's the thing. Just how I'm always going to feel like I'm behind. Regardless.
Yeah, I think I think most people do. But this comes from an article that I found, but this is also actually pretty pertinent right now with the conversation I had with, I'm going to keep this very vague. Talked to a dentist recently. He was just, we talked to over 400 dentists every year outside of our clients, right? We do consults all the time where a lot of times dentists just want to ask us questions or have us point them in the right direction. This particular person was talking, older person, I mean, older than meaning most people we talk to, in his 60s. And he just needed some advice. He just needed to be pointed in the right direction because he was quite a bit behind in his retirement savings, like, very much so. And so it was very pertinent to talk about this. And this is, Victoria, Rabih, we're sort of joking, but also being serious in the sense of you guys are saying like you feel behind even at this point, or your first reaction to that question was like, yeah, I'm behind. So, and we see this all the time with dentists that we talk to. This is a survey done that showed that recently. So a CNBC survey showed 40% of Americans say they are behind on retirement planning. I guess I want to get your first response. I actually thought that was kind of low. I would have thought that more would have said that. What do you guys think on that?
Was that how the question was framed to them? Like just like how they felt?
Yeah. So what this says, 4 in 10 Americans, 40% are behind on retirement planning. So I don't know how.
I wonder what that means. Yeah.
They polled almost 7,000 Americans on this back in August, and they said 40% are behind. So how are they actually tracking that would be interesting.
Yeah.
We obviously have our ways of looking at that. But so I'm not sure the methodology, but they are saying 40%. So you're right. My guess is if it was how behind are you or how do you feel, my guess is that number would go up. I would think.
Yeah. So I just kind of want to know how that was gathered. But if it was objective, and they had some numbers to back, I don't know. I feel like that should be probably higher because I think a lot of people do rely on Social Security being there. And we have our different takes on if it will or it won't. We won't get into it. But that seems kind of low to me, to be honest.
Yeah. So they broke this down. It goes a little further and breaks down this by age. So it said 37. This is actually pretty interesting. We talked about last week with Jake around this inheritance, right? People inheriting and counting on inheritance. And if we really think about this, baby boomers are really the first generation in America as a whole to even be tasked with the idea of a true retirement plan and planning for retirement.
Oh, sure. Yeah.
Generations before that was very heavily reliant on pensions. It was more of a thing. So retirement is really a newish concept in America. And I would argue even outdated already. But 37% of baby boomers between ages of 60 and 78 said they felt behind, compared to 26% of Gen Xers and only 13% of millennials. And only 5% of Gen Z said that they felt behind with retirement. So the younger you get,
you are. Okay.
Now, I think, I'm going to guess there's some psychology behind this, that the younger generations, let's say you talk to a 25-year-old, said, do you feel behind on retirement? They're going to be like, no, I'm 25. Like, what do I care? Whereas you ask a 65-year-old, they're so much closer to that they're going to feel like, I just think that alone is going to show that an older person in general is going to feel more behind than a 25-year-old.
Well, yeah, because they're right there and they're going to have to live that life. And I don't think that, Gen Zers are really thinking about retirement. It's really hard to conceptualize that.
Yep, definitely. So the reason I wanted to bring this up is probably to point out a couple of things. So the number one thing that across the board, all these people surveyed said, and this is not going to shock you, the number one thing they regret and that led to this feeling behind was not starting soon enough, not starting early enough, which is, again, not a shock to me. It's so simple, not easy, but we say starting. The best time to start was yesterday. The right time to start is now. Like, you can't go back, but starting now is going to always be the answer. Whether, I say this all the time when someone's like, is now a good time to invest? Yes. The answer is always yes. So starting early was by far the number one thing they said they wish they would have done. And, what we say all the time is, yeah, you're shooting for 15% to 20% of your income to make retirement feasible. But just start. It doesn't have to be that amount. Just get started, build that habit early, and you're going to be in a much better position down the road. Rabih, I want to ask you any thoughts on any of this?
I think with the questions like, how do you feel about retirement? There is an objective answer to know whether you are on track or not. But I think the average person does not know how to tackle it, right? So depending on whom they hang out with or what type of financial situation they grew up in, will determine and bias their answer on whether they feel they are ready for retirement. Some people might have the same spreadsheet data and both are not ready for retirement, but one of them would think that they are. So, I'm like hinting that everyone should know what the spreadsheet answer should be, or have a financial advisor to tell them whether they are on track. Because if you don't know the building blocks, how would you answer this question? And is it going to be just based off feelings?
Yeah, it's a good point. Victoria, your thoughts?
Well, yeah, I was just pulling up something because I remember years ago when I was studying for the CFP, they kind of had this table where it was like at certain ages what your savings rate needs to be. So I just pulled one up from Fidelity. So assuming you retire at 67, these are the different ages in which you start saving. So if you start saving at 25, retiring at 67, you need to have a 15% savings rate. Pop that to 5 years later, you start saving at 30 instead of 25. That now needs to be 18%. Pop that even further at 30. If you start saving at 35, that has to be 23% of your income. So It just kind of goes to show that, you even wait a few years, your savings rate has to be higher. So it's kind of, and for dentists, this is hard, right? You can't save 15% of your income when you're 25 because there's a good chance you're still in dental school or your residency. So that's fine. But, the earlier you can start, the lower your savings rate needs to be. And therefore, later in life, it doesn't have to be 20, 30, 35%.
Yeah, that's a great point. And obviously there's some nuance here. Like, we talk in generalities on the show for a reason, because we can't address every individual situation. But there's obviously a vast difference between, a dentist who's building a multi-location type enterprise, right? Yeah. Business versus a career associate. Mm-hmm. Like, the way you approach your savings, let's say into a brokerage account or a 401k or whatever, is going to be different. The assets you're relying on for your retirement are going to be different. So if you're a dentist out there saying, well, I'm building up kind of a mini DSO, like my focus has been building up my assets in my dental practices. I'm now going on my number 3 or 4 or 5th practice to eventually sell this. You're probably not going to have that standard approach of a career associate. It's like, max out your 401k, put money in a brokerage account. Like it's different. So we want to emphasize that so people aren't out there being like, well, I'm never going to retire because I'm not saving 15% or 20% into a brokerage account. It's
Right.
like, no, there's different ways to do this.
Well, yeah, because if you think about it, investing in your practice and growing that is in a way, right, saving for retirement.
Exactly.
So you work with a traditional financial advisor, they're not going to really understand that. Versus we know, going into debt for your practice and really investing in that is part of your retirement asset.
Yes.
Or part of your retirement asset. So it's fine. These, again, are just general rules. And that's why we exist at all, because there's so much nuance to it. It's very different person to person, because you could look at that as a practice owner and then think, oh gosh, like I'm screwed. And you're not. You're probably not. So
you're probably not.
Probably. I have to speak generally. Right. So you're probably not, asterisk.
Yeah, I would say that for most people out there, no matter what you're doing, no matter where you fall in the dental space, saving just to save, even without a set number or set goal, building that habit of building up some, let's say, liquidity in a brokerage account or maxing on a 401k, like that's never going to hurt you. Yeah. So, and again, starting early as you possibly can. It's amazing how many times we talk to people who set up and systematize it too, right? Because how many people we talk to that set up an automatic, savings draft to a brokerage account, and then 5 years later they're like, "Holy cow! I did not know how much I could actually build this in this thing, and I'm not even thinking about it."
Right.
And so systematizing as much as you can. I did find another part of this that was interesting. It says only 1 in 5 people surveyed said they feel confident they will be able to fully retire with a comfortable lifestyle, according to this Retirement Outlook of American Middle Class report. So, which means 80% of people are saying, if you inverse this, are saying that they're not confident at all that they're going to be able to retire. And the key there is with a comfortable lifestyle. So the last thing I'll say on this, and then Rabih, I want to get any final thoughts you have, but oftentimes people will ask us, well, how much do I need to retire? What should I be thinking about? Again, generally speaking, but from our experience, just being honest, a dentist, a typical dentist out there, if you're looking for an actual dollar amount, you're probably $5 to $6 million, $5 to $6 million in assets and usable net worth in retirement. If I'm just saying generally speaking, based on what we're seeing from lifestyles of dentists, that's going to vary widely depending on your situation. But if you're shooting for 5 to 6 million in usable net worth, that's a worthy, I think, number to be shooting for. Rabih, any final thoughts on this topic from you?
I like that you hinted on usable net worth, because it's like a very recent example with a client where their net worth is high, but their net worth is not liquid. It's in a bunch of real estate and they don't want to sell their real estate.
Sure.
And their usable is mainly their retirement accounts and their brokerage accounts. And while on the grand scheme of things, their net worth is high, it could afford a 3% withdrawal out of it every single year. Their money is supposed to last them in perpetuity, between quotations. Their usable net worth does not allow that. And looking at only their usable net worth, they were not ready for retirement. So being there also will depend on the asset mix. And I'm glad you mentioned that.
Yeah. And I also emphasize usable net worth when I'm talking to dentists to say, your personal residence should not be factored into this. There's that falls outside the usable part of it. Unless, and sometimes I'll get pushed back and say, well, in retirement, I'm going to downsize. Sure, you will. You might downsize.
You're salty.
I'm just saying, like, I've never seen it. So
yeah, it doesn't happen.
And you might downsize. As Ryan has said many times, and I stole this from him, you might downsize. You're not going to downgrade. So, the expense of that home is not going to change. In fact, I see far more often that dentists nearing retirement get into that quote unquote dream home. They actually spend way way more money on homes later in life than they do early on. So I'm not saying it's not possible, but if you're counting on, oh, I'll sell this house and just go live in a condo, and like, again, no, you won't. I've never seen it in 11 years of doing this. So
yeah, it's really hard for humans to downgrade in anything.
yeah, it really is. So, okay. Any other final thoughts on that? Retirement savings. Okay. Let's jump to the last one. What is the cost of denial? Study buddy.
What
Also,
say ye?
Excellent question, Rabih. That was a shout out to Rabih. What's the cost of denial? Coming up with a saucy question.
Yeah, if people don't know, right before this, we all get on with our topics, and then we try to come up with the most dramatic question we can possibly think of.
Like last week's about waiting for your parents to die. I think
Yeah.
that was all Jake.
So there you go. Well, okay. I kind of was thinking about this because I heard of a term called, have you guys ever heard of the term procrastinating?
Procrastinating cleaning your place or something?
No, other way, actually.
Oh, you clean to
Procrastinating?
procrastinate. We're doing something else.
Got it.
Okay.
You just mentioned this to me the other day.
Yes. And we were
Okay.
kind of talking about this, and then some client situations came up where I was like, "Oh, the dots are dotting. Here are some parallels. And we have a podcast, so I can talk about it.
Perfect.
Process my own feelings on this. Anyways.
So wait, so procrastinating is you procrastinate what you have to do by cleaning?
Yes.
Got
And
it.
so I do this, and a lot of people will do this, and there's parallels to other things where you do something productive so you don't feel bad about avoiding the thing that you really have to do.
Got it.
For instance, if there's been times, I have a bunch of work to do and it piled up, and I'm like, oh, I don't feel bad putting that off if I'm deep cleaning my apartment. Like, the oven needs to be cleaned. The
course.
baseboards need to be wiped down. The blind, I just kind of will keep thinking of things that make me feel better to focus on rather than the problem itself.
So it's really quick. You use the word productive, but I would actually push back on that and say you're keeping yourself busy, not to be productive.
Yeah, I guess. Sure. But
Cleaning your oven is not productive. It's just keeping you busy.
I don't know. I think there's a little bit of both there because
Okay.
you don't want a nasty oven, do you?
Well, sure, but
When's the last time you cleaned an oven?
I mean, I don't know.
This just means that Matt is very productive.
And that
I'm
really busy.
never busy. I'm just always productive. Yeah.
No.
That's going to make a really bad joke. Never mind. Moving on. But again, I think there is a key there of like the difference between being productive and being busy.
Well, and I'm framing it in my mind. And I mean, I guess in that sense, like,
Yeah,
yes,
you're making excuses for yourself. I get it.
Yeah, no, we do that. But I mean, there is something that's positive that comes out of this. I get to live in a clean place.
Yeah, you have a clean oven. Yeah.
Yeah, I have a clean oven and my food's great. So anyways, I think I was drawing some parallels because we've had a few client situations where I've seen this, where you kind of focus on other things and it's like, oh, I'll get involved in real estate or this private investment or blah, 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 instead of, oh, I just need to pay my taxes or I just need to pay my credit card down. And you kind of avoid the root of the problem, and almost addressing the problem feels like admitting you did something wrong. So if I can focus on doing these other things that I have created the story in my head that it's productive, it's better for me, I'm going to be better off, instead of addressing the root of the problem, or even, God forbid, addressing your own, holding yourself accountable. Right. I think it's just interesting because I think that framework or the story you tell yourself can be really expensive. How expensive? I don't know. That was just the spicy question we came up with so that people would listen to this segment of the podcast.
So they would
and
not.
Here you are.
And here you are if you're listening. So what you're saying is you can't answer the question of what's the cost of denial.
No. I mean, how could I quantify that? I don't know.
Let's just make something up. I do that all the time.
$3 billion.
Robbie's got thoughts.
I think you can calculate it based on the person. So if you decide to procrastinate or whatever you do and waste a month of not paying your credit card debt, that extra interest payment is going to be the cost of denial.
Or waiting to invest, right? Like not setting up your IRA or your brokerage account. So that can be the opportunity cost of not investing, how expensive it is to not pay your credit card down or start saving for your kids,
Yeah.
It's hard to quantify.
Yeah, I was just kidding. You can't quantify it at a general level, but to Robbie's point, you can quantify this at an individual level, and maybe not
Yes.
to the exact dollar amount, but we see this all the time with dentists, of this denial, of this avoidance of these money issues, or like you said, getting started. How about something as simple as getting organized, like taking the
Yes.
actual time to say, you know what, I'm going to spend some time with my spouse or partner. We're going to sit down. We're going to start tracking our spending. We're going to build out our balance sheet and understand
Yep.
where we're at. You got to know, that's the first unsexy truth of this, is like organization is the first step of any level of progress when it comes to money.
Yep.
And so I think there's a massive cost for people, multiple six figures, probably seven, it could be seven figures
Over time.
over the course of your
sure.
life, if you're the longer you avoid it. And the problem is, the longer you avoid it, the more costly that becomes. And that number compounding works for you and against you, right? So that compounding effect can be something that destroys you on the wealth side if you're letting it compound against you, or again, works for you. It's a tool that you either use or it's used against you.
Yeah, I mean, you could see that in spending. Like, I've had some clients not realize they've had a gym membership, and it's been like for them and their family, and it's $500 a month, and they let 6 months go by. And I'm like, I would rather have $3,000.
Yeah.
Or clients who have old insurance policies and they don't realize how expensive it is and that it's not useful to them. So this is like avoiding this and not getting organized. That's really expensive.
Yeah, I agree. And the counterintuitive part of this too is this whole saying of ignorance is bliss, right? I think that's a lot of at the root of this, where people, and we see this, like, and I feel this in my own life, of it feels easier and less scary or painful to just not look at it, right? Like, for example, I don't want to know what my net worth is. Like, thinking of like dentists, like, I don't want to get organized and know what my net worth is because I feel so behind.
Yeah.
But we've challenged this premise that ignorance is actually not bliss. And studies show this. We've referenced these studies before that show it's actually, people, like, the uncertainty of it actually eats away at you way more and is way more painful than if you just take the time to get organized, actually address. Let's use the example again of net worth. We have seen this so many times. People that even see a negative net worth after we've organized them and show them where they're at, they're, even in those situations, it's relieving.
Yeah.
They're like, okay, like, it's actually not that scary. I kind of already knew where I was at. And I'll also say this, Victoria, maybe you can back this up from your experience. I'd say more times than not, probably 80 to 90% of the time, when we get a client organized and show them their net worth, oftentimes for the first time, 80 or 90% of the time, I'd say it's better than they thought.
I fully agree with that. People tend to beat themselves up, and then they just build it up in their head, and then I'm behind. And because you have that, you've added that extra layer of stress and whatnot, you avoid further, and then the story becomes bigger and bigger. And honestly, to your point, most of the time it's not nearly as bad as you think. Granted, there are some where it's like, oh, this was a lot worse than I thought. But
sure,
even in those moments, I wholeheartedly agree. Just having the clarity around it just gets you out of the corner, because you've backed yourself into a corner. You've told your story that reinforces you into that corner. But just shedding some light gives you a way out instead of continuing to just shove yourself in that corner.
I think that's a general rule for life, really, across the board, which is your imagination is far scarier than reality.
Yes.
In most cases, we catastrophize. And again, your mind will take you to scarier places usually than what reality. Not in every case. Obviously, people out there are like, that's not true for me, whatever, we know. And I'm not saying it's been true for me personally in every single situation, but I'd say more times than not, my imagination, my ability to catastrophize something is far worse than the reality of life.
I'm really good at catastrophizing.
Oh, we know.
We know.
We've worked with you long enough. Rabih, let's get you in here for any final words on this.
It looks like you're trying to balance out between two types of pain. One pain is the pain of facing the problem, admitting something to yourself, just, acknowledging your losses and moving on. And the other pain is the pain of uncertainty and the pain of going into this spiral of I'm in a stress. And there's going to be a tipping point where the pain of not doing it is much larger than the pain of doing it. And then you'll just go and do it.
I totally agree. We've talked about this before, like off air, just in conversations, right? But I think a general rule here is the avoidance of pain will always create suffering, like long-term suffering. And I'll say this, I guess I'll get more specific. The avoidance of short-term pain will always cause long-term suffering. And so I think that's kind of the heart of what we're saying here is continuing to, what did you call it? Procrastinate or push off those conversations with a spouse or partner. We got to sit down and track this. I know I need to like get my retirement savings going, whatever it is, like that thing you're avoiding because there's some pain involved or maybe some perceived pain is going to cause a lot bigger problems and a lot more suffering down the road. So I guess a call to action here for everyone listening is you all know what you're avoiding when it comes to your money. Every single one of us is doing it, but we've given numerous examples. Just take one step closer, not avoiding it anymore. Like take some action, one step. Don't address the entire thing. Like if you're sitting out there saying, building a balance sheet or my net worth statement seems like a lot. It's okay. Okay. Just like start locating some accounts, like take one step towards, get a piece of paper out and start writing down your accounts. Like just take one step towards it.
Yeah. Or if you've been putting off opening a high yield savings account because your emergency fund is in your Chase savings account earning 0.01%, just open the savings account, and get that transferred. That's a step in the right direction.
Yep. Just one step. Yeah.
Well, you shared a quote with me once, Matt. It was something along the lines of like,
that doesn't sound like me.
No. You're the quote master.
Sharing a quote?
Here.
It doesn't seem like me. That's weird.
Let me bestow my wisdom onto
Not my
you.
Wisdom. Yeah, right. Someone else's wisdom. I steal everything.
Oh, you're a quote thief, and I love it.
I totally am.
Well, something to the tune of the magic is in the work you're avoiding.
Yeah.
Does that sound right?
Yeah.
I don't know. I stole that from you, and you stole that from another man.
I did. I heard this on a podcast recently that, the magic is always in the work you're avoiding. Yeah. And that's just more like life. Like, I think you could say magic is in the thing you're avoiding. Whatever you're avoiding, there's like something positive on the other side. So
yeah.
We're getting very philosophical here. Robbie's like, I love this.
Robbie loves it. He just needs some Bob Marley in the background, and then he's set.
For sure. Okay, this was awesome. Any final words? Any final words of wisdom from you guys?
Do I have time to talk about the Chase Bank money glitch, or is that
hit it?
Really? Okay, this is super fast. Okay, so some guys on TikTok a couple weeks ago, this went viral. Like people were lining up outside Chase Banks because they were perpetuating this story, this money glitch from Chase Bank, that if you wrote a check to yourself, and they were doing this by like the tens of thousands, like $10,000, $40,000, $80,000, you deposit it into your account and then you immediately withdraw it. And so this went all over TikTok saying like, Chase Bank money glitch, you can get free money. So people, I'm not kidding, there's videos of them just lining down the street, depositing tens of thousands of dollars into their account, pulling that money immediately. And they're like, yeah, it's free money. That's called just check fraud. And Chase Bank came out and was like, please don't do this. Like, we're going to come after you. Like these guys on TikTok literally were like, I'm such a genius.
Yeah.
Look at you guys. We can get free money. That's just check fraud, my guy.
Yeah, my guy. We've seen these videos before, Victoria, right? Of these influencers that are spouting. The general thing here is just, please don't take advice from people on TikTok. Like just as a general rule. I'm not saying they're all bad, but like, I think if you're going to be better off just not listening to people on TikTok. I think that's pretty safe to say.
Yeah. I just love how he discovered check fraud.
Yeah. He's like, this is a hack.
Yeah. They literally called it like a money glitch, a money hack. I'm like,
guys, it's free money. It's free money.
You just learned what check fraud is. Congratulations.
Like, too dumb to even know what they're saying is like fraud. Guys, no, it's not. It's so simple. It's so simple.
Just write a check to yourself.
TikTok is a great place. TikTok is a great place to take advice if you want to become a criminal. Like, there's no better school.
Yes, it's great. For sure. Oh, I've seen some bad things of generally dudes in pools floating on like a floaty talking about.
Why is it always a guy?
It's always a guy in a pool being like, yeah, just open up this credit card under a fake business and rack up all this credit card debt and then file for bankruptcy and then you never have to pay it. Like that's not, I'm just like, you guys are insane. Please do not listen to any of these people.
Yeah, it's always a guy floating in a pool or a guy with a mic and some headphones.
Very good.
Okay. Well, she woke up choosing violence today. Okay. Rabih has just said in the chat that his sugar levels are at an all-time low. The good thing is, Rabih, we have a fix for that. They are called maple donuts over in the other room. So we'll go ahead and grab some of those. Rabih, Victoria, as always, thanks for being here. If you've gotten this far in the podcast, we love you. Thank you so much for listening. If you'd like to talk to us, we'd love to hear your story, be able to point you in the right direction, answer some questions for you. Go to dentistadvisors.com. Click on the yellow button, book free consultation. We would love to talk to you. But again, as always, thanks for listening. That was our 2 cents. Have a great weekend. Bye-bye.